And Candice, thank you very much for joining us. Let's talk about what Fed Chair Jay Powell said. Did anything in there resonate with you about whether or not the markets can continue this uptrend, given the fact that we are seeing more action from the Fed and potentially more action from governments on the fiscal side of things?
Yeah, well, thanks for having me. And I guess I would just say that, markets have been surprisingly resilient, even in the wake of the number of risks out there. We're seeing rising COVID cases, some geopolitical headlines as well. And Powell's speech and his testimony largely reinforced that we're not out of the woods yet. While indeed the retail sales numbers, the economic data has been encouraging as economies reopen, what he's reinforcing is that the path to recovery is likely to be uneven and protracted, and there will be some long-lasting damage. So I think equities might just be getting a little bit too complacent on some of the risks, particularly as we don't know exactly what the recovery will look like in the absence of a viable therapeutic.
So I've heard the commentary that the Fed is not a vaccine. The Fed is not some kind of panacea for everything that ails the world right now, but it sure seems like it is because the markets seem to only pay attention to what's happening there. Is that sign of complacency? And what exactly does that mean? What exactly would set the markets lower if the Fed seems to be the cure-all for everything?
Yeah, so equity market gains have predominantly been driven by the very assertive response from central banks across the world and governments as well. This has largely been what's been able to see the markets continue that run higher, even in spite of some of the risks out there. So it's definitely a positive. And that unrelenting support is likely to continue, as you were saying earlier. Now, at these levels, though, we've hit a point where in the absence of any visibility on the future and the path to recovery, markets just could become a little bit vulnerable to some consolidation, whether it's the negative headlines on the geopolitical front. We've got the reemergence of U.S.-China tensions, civil unrest across the U.S., even, the latest news on the rising COVID cases that could potentially restrain the magnitude of the recovery. I think this could potentially spark some profit taking from these lofty valuation levels.
All right, so those big runs that we've seen from certain industries and sectors may have the biggest pullbacks. What exactly then goes on investor shopping lists if we do see this kind of period of consolidation as you may be forecasting for?
Yeah, so if we saw a sizable pullback in the order of, say, 10 to 15%, this would be a good opportunity to reallocate back into equities. Like I said, at these valuations, I would resist the temptation to chase the rally, particularly given that we don't have a lot of clarity on the path of the economic recovery, the speed, et cetera. And when it comes to sectors, in order to get that cyclical value-oriented rally moving again and to be more sustainable, you're going to need a more durable economic expansion story. That is going to depend on a viable therapeutic that will allow for that swift market recovery that equity investors are currently anticipating. But in the absence of that, I think there could be a bit of a defensive bias. So your growth sectors would likely, do better in the uncertain environment.